Okay, let's dive into this. Welcome to today's Explainer, where we're going to unpack one of the most baffling, contradictory, and honestly just downright fascinating financial profiles on the market right now. We're looking at Coeur Mining, ticker symbol CDE. Now, if you look at this company from one angle, it looks like the absolute investment opportunity of a lifetime. But flip it around, and it looks like a complete financial black hole. So today, we're going straight to the raw data to solve the valuation mystery of Coeur Mining. I want to start by throwing a number right at you. 7,534.86%. Just take a second to let that sink in. That right there is Coeur Mining's trailing 12-month free cash flow compound annual growth rate. For anyone trying to wrap their head around that, it means their free cash flow, the actual cold hard cash the business generates after capital expenditures, has absolutely exploded over the last year. I mean, in the finance world, a 50% growth rate is incredible. A 7,500% growth rate? That is statistically absurd. It's the kind of metric that literally forces you to stop whatever you're doing and pay attention. And as you might expect, Wall Street definitely paid attention. Back on May 2nd, 2025, Coeur Mining stock was sitting at a 52-week low of $5.21. Fast forward to our current data, and it's trading at $18.88. That is a massive, towering 262% jump from its absolute bottom. If you had the perfect crystal ball timing to buy in May, you more than tripled your money in just a matter of months. And this brilliantly illustrates that it isn't just the stock price that went up. The underlying fundamentals over the last 12 months look like a literal rocket ship. Trailing 12-month revenue has nearly doubled, growing at over 96%. But the most staggering fundamental here, net income. It's skyrocketed by almost 895%. This is a business that has executed an explosive one-year turnaround. We're talking triple-digit growth across the board. If you only looked at the last 12 months of data, you'd probably be scrambling to hit the buy button right this second. Section 1. A disastrous long-term history, zooming out on CDE's performance. But here's where we need to pull back the curtain a bit. As any seasoned investor knows, a single year of data rarely tells the whole story, especially in the notoriously cyclical mining industry. We need to transition away from this euphoric short-term data and look at the historical context. Look at this stark juxtaposition. On one hand, we have that booming short-term excitement of a 231% trailing 12-month return. But look right next to it. The 15-year return is negative 41.38%, and the 20-year return, negative 72.95%. This is terrifyingly bad long-term performance. We're looking at massive value destruction for anyone who bought and held this stock over the last 2 decades. So the short term looks like a gold mine, but the long term, well, it looks like a graveyard. The story of an investor's portfolio over time is just wild here. Like we said, that one-year return is completely off the charts. If you held for 5 or 10 years, you actually managed some modest gains, around 10 to 13% annualized. But stretch that timeline out to 15 or 20 years, and you are bleeding money every single year, sitting at an annualized return of negative 6.32% over 2 decades. You really have to ask yourself, what does this mean for a long-term hold in your portfolio? It strongly suggests that while Coeur Mining can experience these incredible, explosive cyclical peaks, it has historically failed to create compounding value over the truly long haul. Section 2. Under the hood, the engine of profitability. Let's move to and see how this builds. Right now, today, the company is undeniably printing money. To understand why this massive turnaround happened, we've got to look at their current balance sheet health. And honestly, it's remarkably solid. Their debt-to-equity ratio is incredibly low at just 0.10. That means they rely very little on debt to fund their operations. We balance that against their current ratio of 2.47. Since a current ratio over 1 means a company has more than enough liquid assets to cover its short-term liabilities, sitting at 2.47 means Coeur Mining is exceptionally liquid. They are in absolutely no immediate danger of a liquidity crisis. And that financial stability allows them to really capitalize on their margins. Almost half of their revenue, 48.45% to be exact, flows straight into gross profit. But what's even more impressive is how much of that trickles all the way down to the bottom line. Their current net profit margin sits at a very healthy 16.22%. Now, to give you some context on why that is such a big deal, Coeur Mining's average net profit margin over the last 3 years was practically non-existent, just 0.81%. So they've radically transformed their ability to turn sales into actual bottom-line profit. Which brings us to the operational fuel for this current stock price explosion, return on invested capital, or ROIC, which is currently sitting at 16.53%. This metric basically tells us how efficiently a company uses its capital to generate profits. And just like their profit margins, this is a massive jump from recent history. Their 3-year average ROIC was a mere 2.28%. So right now, their capital allocation is highly efficient. The business is quite literally firing on all cylinders. Section 3. The Valuation Reality Check. The Plot Twist. So we have an explosive 12-month turnaround, phenomenal current liquidity, and massively improved margins. But no matter how well a business is operating, the ultimate question for an investor is, what price are you actually paying for those operations? That brings us to the margin of safety. Now, what's really interesting about this slide is how we define this concept. Let's briefly break it down so we're all on the same page. The margin of safety is a fundamental investing principle. It's simply the difference between a company's intrinsic fair value, which we calculate mathematically based on its future expected cash flows, and the current price the stock is trading at on the open market. Basically, it measures true mathematical value against market hype. You always want a positive margin of safety. You want to buy a $10 bill for $7. With that defined, let's drop the hammer and look at Coeur Mining. We have the current market price of $18.88. But then we have the fair value price, calculated using discounted cash flows. That intrinsic value is just $5.33. Let that sink in. That is a massive, incredibly dangerous gap between what the market is enthusiastically paying for the stock today and what the actual cash flow mathematics say the company is inherently worth. So the crucial point is exactly this number, negative 253.97%. That is Coeur Mining's current margin of safety. The math suggests that the stock isn't just a little overvalued, it is massively, astronomically overextended compared to the cash it realistically generates. The market is completely decoupled from the intrinsic valuation here, basically pricing in absolute perfection for years to come. And we can reinforce this overvaluation theme by looking at how the stock is priced relative to its peers. A PE ratio of 20.75 might not sound crazy if we're talking about a tech stock, but remember, this is a mining company with a highly volatile history. Even more concerning is the price-to-sales ratio of 9.24 and an enterprise value-to-sales ratio of 9.13. You are paying over $9 for every single dollar of revenue this company brings in. Despite the incredible operational turnaround we looked at earlier, paying this kind of steep premium for a capital-intensive mining business, well, it leaves almost zero room for error.
Which leaves us with the ultimate question. Is Coeur Mining a genuine, lasting turnaround, or is it a massive value trap just waiting to spring? On one hand, you've got over 7,000% growth in free cash flow, incredible current liquidity, and a spectacular one-year stock chart. But on the other hand, you've got a 20-year history of destroying shareholder value and a stock price trading at an alarming 253% premium over its intrinsic mathematical fair value. The data tells two completely different stories. It's an incredible mystery, and the decision on which side of the data to trust ultimately rests with you. Thank you for joining me on this explainer. Keep analyzing those numbers, and I'll catch you next time.